Let's take a quick look here at the North American equity markets just before the closing bell. So we certainly have seen a nice update today with the Dow up by 367 points. And we're actually seeing the Dow level off here a little bit, but we're closing close to the highs of the day right now as we head into those closing bells. For a market reaction, let's now bring in Bob Iaccino. He is the Chief Market Strategist with Path Trading Partners. Bob, great to be able to catch up with you. What are you seeing in the market right now? Thank you. What are you seeing? And what I'm curious about are these low volumes. What's going on?
Yeah, I think there's you know what, I hate giving you the theater of the obvious that probably 20 people have said today. But we've still got that one domino left to fall in order for this bull market to actually take hold. And we can look at economic data, both here and overseas again. Once that happens, if that happens, I happen to believe it will, and that's obviously the U.S.-China trade situation. We've got this new overhang of a potential recession in Europe, which I feel has about a 50% chance. Data is coming in now, but could be averted if we get a U.S.-China trade deal. There'll be a little bit of a spark there, and then potentially we start actual negotiations with Europe, U.S. to Europe, and getting some of those deals papered and in place and voted upon, and then maybe this can go up again. It's interesting to me because what we've seen in the U.S. is a very weak start to the recovery looking back to 2010, 2011, the couple of equity dips we had there, but a fairly robust middle to end of this recovery. I believe this is the end of the cycle, but I believe we still have a year and a half to 2 years of it to go. So I'm bullish equities. Just got this trade thing in the way.
So when you say end of a cycle, and you think that we're at the end of the bull market cycle, but the market can still move higher for another 12, 18 months just because we've got some tailwinds?
Yeah. Yeah, I do. You know, looking at the earnings scorecard as of Friday, again, according to FactSet, which is where I check every Friday, we've got about 65% of the S&P 500 reporting, with about 71% beating on EPS, about 62% beating on revenue. The issue is, of the 65 companies that issued forward guidance in the S&P 500, 53 of them issued negative guidance, and the vast majority of those mentioned trade tensions, trade tariffs, trade worries, and trade wars, the four trade phrases, I guess. And if those get out of the way with a 12.2, 12.0% blended earnings growth rate, yeah, I mean, it's not 20, 25, but it's still good. We're still above the 10-year average on whether the market is cheap or expensive, below the 5-year average, a little bit more affordable there. So for what we do, I definitely have to remain bullish with my fingers crossed that we'll get a deal.
So, Bob, what are you doing, though, in the market, or where are you seeing the opportunities, or where are you seeing people take some profits? I mean, on a risk-on day, it feels great if you own the banks. It feels pretty good if you own consumer discretionary as well as tech. And then the minute things reverse, it's like, oh, my goodness, why didn't I sell? So give us a little bit more granularity in terms of what's going on underneath the surface, who's trading, what are they doing, what are they thinking, and is it sustainable?
Next time we have time, let me explain why I hate risk on and risk off. Those particular phrases drive me crazy because they generally just mean people are buying, people are not buying, right? Risk on to me is what you do over a period of time. So the last time I talked to you, we were about 70 to 80% in cash. We're about 40% in cash now. So what I think people are doing, based on what we do and people we talk to, advisors, other advisors that we talk to, other institutions we talk to, they're doing the same things as per their models. They're starting to buy things that they want to hang on to, things that we've bought recently, for example, is Caterpillar, Phillips 66, Valero, not necessarily Caterpillar tied to a trade deal, obviously, but that's not why we bought it. When you've got a huge majority of companies pulling down their forward earnings estimates, the value you can get for price now versus forward earnings, which is the value you want to buy, right? A discount to forward earnings gets smaller and smaller until the prices fall. Once those prices fall, even though the forward earnings are pushed lower, you've got a nice discount at the current price. So that's where we've been kind of digging in. We got out of FANG, though. That's the one thing. I mentioned that earlier when I was talking to Michael, your producer. We got completely out of FANG because the momentum may not play with some of the nervousness and low volumes that you've been talking about.
So when you step in and you buy a name like Caterpillar because it's been down and there's more valuation opportunity per se, are you really investing right now from a tactical trading perspective, or are you saying, you know, I can get it at a good valuation, I'm going to ride this up for the next 5-10 years? Because the reason why I'm asking is I think that there's just such a distinction in terms of how one could and should invest in the market today versus a couple years ago. Is that what you're doing, or do you buy and hold?
Well, that's a great question. So you're talking to two people, and I'm sure your viewers are not split down the middle in terms of what these two types of people would be. We generally hold things for a month to 3 months in the equity cycle, in the equity markets. That's not necessarily because the stock has suddenly become value, but because the discount that we bought it at has shrunk if we were right. So we want to buy things that have a substantial discount and then take a portion of that move and exit those trades. Now that doesn't mean that when we get into something, it won't run for 3 to 5 years. It's just not what we do. Again, an example like Caterpillar. Caterpillar is a really, really strong company, pays a good dividend. And if we get a US-China trade deal, even if it's the existing deal renamed, as many people say the USMCA was, at least we go back to zero, and Caterpillar was doing well at zero. So because I only believe that the bull market has about 18 months in it, I wouldn't necessarily tell anyone to buy what I'm buying for an 18-month hold period. But we take portions of moves. So that's a great question. It's an appropriate question.
And I'm just wondering as well, when you take a look at the financials, you know, they've had a tough time getting out of their own way. They did well today. Up by about 1.5% or so. But it seems as though, if we take a look at the XLF, it seems as though, you know, if we've got a slowdown in the Fed raising rates and tightening the balance sheet, the financials don't act as well. But that is the scenario we're in, and here it is. People are buying them, perhaps because they think that they've got, you know, a Fed put. How do you look at the financials today? There's no consistency in terms of the performance of what people care about.
Well, we don't own any of the money center banks. We've glanced at some of the regionals. We actually were going to buy BB&T. We didn't do it in time prior to the takeover/merger, so that was a little bit of a miss. But it's mostly because we can't really value them when you look at what goes on with the yield curve and what the Fed may or may not do. Speaking of the Fed, I personally think if you're somebody that's looking at financials because the yield curve will steepen and that's good for the banks, I don't know that it's going to steepen until we see inflation. And once we see inflation, I think it'll steepen dramatically. And the reason I say that is I think the US Fed kind of learned its lesson a little bit, partially from Europe, partially from what happened here. In terms of pushing rates too quickly, considering how long we've underperformed to the inflation target, it's possible that the Fed is thinking, I don't have a quote to give you, but it's possible, I think, that the Fed is thinking we should probably let inflation run a little bit hot, considering the amount of time it ran below target. It probably needs a little bit above to get above target. When they talk about that 2% level kind of being a median, just statistics tell you it needs to run hot a little bit for that to actually be the median over time. So I think they may have switched their thinking just a touch.
Bob, just last question here, a bit of a follow-up on the financial front. You don't own any of the money center banks. You don't own the regional banks. Do you happen to own any of the investment banks?
No. we do own TD Ameritrade, so that'd be the only thing that would be in that sort of realm, I guess. But no, we don't own any of the investment banks at this point either. Not a big enough discount for us to get involved in.
Okay, got it. Bob, great to catch up with you. Thank you so much, and thanks for waiting for us a little bit.
Good to see you.
Thank you.